The MACD trading strategy, short for Moving Average Convergence Divergence, is one of the most widely used technical indicators in trading because it is simple, versatile, and effective at identifying market momentum and trend changes, even for beginners who are just getting started with technical analysis. And at its core, the MACD is built on two moving averages: the fast line, usually the 12-day exponential moving average, and the slow line, usually the 26-day exponential moving average, which measure the short-term and long-term price momentum, and the strategy works by tracking the difference between these two averages to create the MACD line, and alongside it, there is another line called the signal line, usually a 9-day EMA of the MACD line, which acts as a trigger for potential buy or sell signals, and when the MACD line crosses above the signal line, it often suggests that momentum is shifting upward, which traders interpret as a potential buy signal, while the opposite occurs when the MACD line crosses below the signal line, indicating downward momentum and a possible sell signal. And one of the most important features of the MACD strategy is its ability to show not only the direction of a trend, but also the strength of momentum through the histogram, which is the bar chart representation of the difference between the MACD line and the signal line, where longer bars suggest stronger momentum in either direction and shrinking bars suggest weakening momentum or potential reversals, making it easier for traders to visualize market sentiment in real time. And while this strategy is useful in trending markets, beginners should note that MACD can give false signals in sideways or choppy markets because frequent crossovers may happen without a strong trend, leading to confusion or small losses, which is why many traders combine MACD with other tools such as support and resistance levels, candlestick patterns, or the Relative Strength Index, RSI, to filter signals and confirm trade entries. And another important application of MACD is divergence analysis, where traders look at how the price moves compared to the MACD indicator. For example, if the price makes higher highs while the MACD makes lower highs, it could signal weakening bullish momentum and a possible reversal, and vice versa for bearish trends, which makes divergence a powerful early warning tool. And in terms of risk management, traders should avoid relying solely on MACD for making decisions, but rather use it as part of a broader trading plan with proper stop losses and position sizing. And overall, the MACD trading strategy offers a very basic yet powerful way to understand when momentum is shifting and when potential trade opportunities may appear, and by focusing on crossovers, histograms, and divergences, traders can gain a simple but effective edge in analyzing market trends. And although it requires practice and discipline to master, even at the most basic level, MACD is a reliable indicator that helps traders stay in line with the market's momentum rather than against it, making it a valuable tool in both forex and stock trading.